We are getting breaking economic news. The Bank of Canada putting out its Business Outlook survey for the fourth quarter. The survey was taken between November and mid-December. The Business Outlook survey overall reading has deteriorated to a reading of 0.1. That's a very low reading, and I don't think we've had a reading this low outside of the 2020 period for quite some time. Also, a key indicator, the outlook for future sales has deteriorated pretty significantly from the last reading to kind of matching around, again, the lowest level since 2020. In addition to some of the details that we're going to be getting in the Bank of Canada Business Outlook survey will be a view of business sentiment, as well as inflation expectations. In terms of sentiment, I gave you that number of 0.1. That is, in fact, the lowest sentiment indicator since the pandemic. So that gives you a sense of the mood kind of souring ahead of a rate decision on January 25th, where it's far from a done deal in terms of what the bank might do. You had a lot of banks after that robust jobs growth in December nudge up their forecast for a rate decision. Of course, as inflation comes in tomorrow, that might change yet again. Just some more details on business sentiment. Again, as I mentioned, it fell to the lowest level since the COVID pandemic, while consumer expectations for short-term inflation held in at a record high. So on one hand, you have a weak business sentiment. On the other, you have an expectation for short-term inflation that is at a record high. More businesses than usual expect their sales to decline, and consumers have reduced their spending plans. Digging through some of the details in terms of what are the factors driving this. Firms said that rising interest rates and high inflation are crimping their outlook for demand, as well as plans to invest. About 70% expect the economy to enter into a recession. So a fairly downbeat Business Outlook survey. Let's bring in Dominique Lapointe, who's Director of Macro Strategy for Manulife Investment Management. Dominique, thanks so much for being with us. I mentioned kind of the survey period. Would you say it's still kind of relevant, this kind of downbeat outlook? Is it a little bit backward looking because it might not have captured a little bit of shift in the Bank of Canada's thinking? How are you thinking about how to apply this information going forward?
Yeah, with this survey in particular, it's always a little bit backdated as it's conducted somewhat in between of last quarter. But I'd say over the past month, we haven't seen any large changes in the global economy or Canadian economy that would contradict, I'd say, the broad lines of what we're seeing this morning, which is unexpectedly, the BOC indicator at large is now near zero. And that's consistent with what the PMIs are saying, global PMIs, with the US ISM for manufacturing and now services are saying. Same thing with the sales outlook, continued to weaken last quarter. It's no surprise given where other more leading indicators have said. So it's downbeat, but I'd note also that it's not collapsing.
And that number, 70% expecting a recession, a recessionary call. I hear you that we are seeing some deterioration in forward-looking economic activity on the manufacturing side, perhaps a little bit on the services side. But are you as convinced that a recession is coming? And if so, what is the magnitude that you're looking for?
Yeah, exactly. And I'd be curious to understand whatever recessions these businesses expect. Is it only a short 2-quarter negative consecutive GDP growth, or it would be a much more prolonged and deep recession? What we do expect for the Canadian economy going into 2023, is actually a moderate recession. That being said, over the past month, we've seen global developments that lead us to be just a slightly more optimistic regarding the economy. So Europe doing a little better than expected because of their energy situation. Same thing with the China reopening. That's a lot of marginal demand that suddenly could be back in the global economy. So consumption is going to decline. We've seen businesses are way less optimistic than they were, but compared to where that survey was taken, maybe there's a little bit more going on in terms of potential growth for this year.
And I'm going to try and find that information on the magnitude of the recession as I'm just going through this report that only broke a few minutes ago. While I'm doing that, Dominique, one of the things that jumped out to me is what all this negative sentiment is doing, because sentiment is one thing, it's kind of those soft indicators, but it turns into real things when you translate into what businesses plan to do. And there's an outlook for lower investment. There's an outlook for possibly lower staffing, as businesses say that higher financing costs are the primary reason that they are choosing to lower their investments going forward. And you know, one of the other ways to combat inflation, in addition to rising rates, as you know, is productivity gains. And productivity gains take investment. And if businesses are not investing it, it sort of prevents that other arrow of kind of attacking inflation.
Yeah, my very, very quick reading of this morning report suggested that we're still going to get some investment. There's still some plan. Same thing for hiring, but these on net have declined. So you see less businesses saying they invest, but on net, I think there's still some capacity constraint, and some businesses want to add. But on the productivity side, you are right. If you compared our GDP growth relative to pre-COVID, and you compare what the US did, they've grown a lot faster. But also on our end, our labor force has also grown faster. So maybe what suggests that businesses are not invested at the level at which they're having new workers, and so they're not getting the most productive capacity for these workers out there. So of course, when we're going into a downturn and then we do see that investment suddenly collapse, I would say that's an issue in the long run, and that's not an issue for the Canadian economy, that our productivity growth has been slower than in other places.
And just another part of this, which is interesting, they have a special section on rising interest rates are weighing on firms' outlooks. And it's just interesting because, of course, they're the ones that are increasing the rates. But that kind of leads me to this question and this thought of, what does the Bank of Canada do with this information? Are they pleased that they're seeing a little bit of a slowdown in activity and that ultimately that will lead to inflation? Or does this make them pause and think, okay, well, maybe we don't need this extra screw of another rate hike for businesses because sentiment is already pretty low?
Yeah, I think if you're the Bank of Canada, you're pleased with that report because, as I said, you don't see anything really collapsing. This indicator, broad indicator, is still near zero, but it's not going negative. We've seen over the past recession. If you're the Bank of Canada, you're looking at businesses' input and output prices expectations. For a second quarter in a row, they're negative. So it means businesses are not expecting lower prices next year. So that's good in terms of the expectations you want to anchor. Same thing with the outright level of expectation that businesses now saying they're anticipating 1 year, 2 years, 5 years out. These have slowed down a little bit. At the same time, again, you're looking at the level of hiring. People still want to hiring, and there's still some underlying strength. So the word soft landing could be associated with that kind of report where you see weakness, but at the same time, it coincides with what you want to see, which is slower inflation.
And we are expecting an inflation reading that could potentially show outright deflation month over month. Put that together with what you think the Bank of Canada is going to do next week.
Yeah, I think for tomorrow, it's highly expected we're going to get a negative number, but that's because of gasoline prices. The Bank of Canada has got to probably see through this. What they're going to look for is their own measures of core inflation, so CPI median, CPI trimmed. Those have averaged about 5% inflation for 3-4 months, and we think they're going to stay around that level. So that means sticky core inflation regarding services. You combine that to a very, very strong LFS report for December showing another 100,000 more job gains, which is surprising, strong wage growth again. Every meeting now, the Bank of Canada is live. That's what they said. They're going to consider the data that came out. And that data that came out suggested more strength in the Canadian economy. So that means, in our opinion, that they're going to do another 25 basis point hike next week.